Welcome to Litebolt, an investment fund that has its own production of miners in the form of the Litebolt X1, a SHA-256 mining farm, as well as our own algorithmic trading bots with integrated deep learning. This video will focus on Litebolt trading bots by first introducing you to our bots and also explaining the methodology and mathematics behind the Litebolt RN2, a Litebolt risk-neutral trading bot. All the formulas with regards to the empirical framework utilized by the Litebolt RN2 are listed here. This video will touch upon each formula as well as showing you how and when they are used by the Litebolt RN2. Over the past year, a select group of members of our team based in London and New York have been trial testing several algorithmic trading bots, tweaking and adjusting certain parameters if needs be. We currently have had 6 bots promoted from successful trial backtesting that have been trading since June 2017, and all have been performing exceptionally. All bots also have integrated deep learning technology based on short impulse dynamics. The theory and methodology amongst the bots differ greatly from theories such as short impulse ARMA models versus VECM models, which directly correlate to the level of risk aversion to its user. We currently have 1 risk-averse trading bot, average returns of 4 to 8%, 3 risk-neutral trading bots, average returns of 9 to 15%, and 2 risk-aggressive trading bots, average returns of 16 to 80%. We shall be productizing a number of our Litebolt trading bots and marketing them from end 2018. At this time, we will not divulge too much information behind the algorithms of every bot. However, let's dive into the methodology and mathematics behind the Litebolt RN2. The Litebolt RN2 is a pairs trading bot based on co-integration. It is classified as a risk-neutral bot and has been deployed on multiple markets such as the London stock market, the US stock market, the FX market, and of course, crypto markets. It has seen average returns of between 9 to 15% every month. First, a pairs trading strategy is centered on the assumed dynamics of the portfolio. The executed strategy at a basic level is as follows. Take a long position in the portfolio when the portfolio is sufficiently lower than the long-run equilibrium, mu minus delta. Short the portfolio when it's sufficiently higher than the long-run equilibrium, mu plus delta. As soon as the portfolio displays a mean reversion to the long-run equilibrium value, the position is closed and the subsequent profit equals 2 delta dollars. Then let us have a look at co-integration, not to be confused with correlation. Co-integration occurs when there is the existence of a stationary linear combination of non-stationary random variables. The variables combined are said to be co-integrated. Let us take an example to explain this statistical property. Imagine a man and his dog. The man has just returned back from a bar and is drunk. He decides to take his dog for a walk with a leash. As they enter the park, the man stumbles and walks at varying degrees of pace due to being intoxicated, and can be imagined as being in a world of his own. The dog is also in a world of his own, as he smells the blades of grass, taking in the different smells and completely ignoring the owner. They are both on a random walk. However, in their random walks, regardless of both internal and external factors, they are both connected and in reasonable distance of each other because of the leash. Whether it is slack or tight, they are still in a quantifiable distance of each other. In Leemann's terms, this is co-integration. But then, how do we determine the long-run equilibrium? How does the Litebolt RN2 know when to execute a trade? Well, to answer these questions, let us have a look at the mathematics of the Litebolt RN2 and how it works. To test the levels of co-integration, the Litebolt RN2 uses the Johansen test. This greatly focuses on the matrix rank and its respective characteristic roots. Intuitively, the Johansen test can be summarized as a multivariate version of the Engel and Granger's two-step co-integration procedure. Considering the univariate case, yt equals alpha 1, yt minus 1 plus error term, whereby the change can be written as follows. If alpha 1 minus 1 equals 0, then the Litebolt RN2 would conclude that yt has a unit root, which it's known to be a non-stationary process. If alpha 1 minus 1 does not equal 0, then yt is a stationary process. This also applies to the bivariate case, as shown. Now, the Litebolt RN2 will then order the variables to ensure correct specification. Granger causality is a statistical test used to ascertain true causality between a set of variables. Though a few econometricians suggested the test merely founded predictive causality, essentially prediction over explanation. Regardless, simply being predictive is sufficient for the Litebolt RN2 in determining a long-term equilibrium whereby the achieved results are key, as opposed to the philosophy of said results. Mathematically, consider two variables, y and x, whereby both variables are stationary time series. The null hypothesis will be h0, x does not Granger cause y. The alternative hypothesis will be HA, x does Granger cause y. To test the null hypothesis, the Litebolt RN2 must include the appropriate number of lags of y for a univariate order regression of y and an error term, as seen below. For your information, an order regression is essentially a model that predicts future behavior based on past behavior, i.e., taking into account its lagged values. The order regression above is expanded to also include the lagged variables of x, the other variable in question. The lagged values of x are then evaluated by their individual t-statistic, whereby only the lagged values of x that prove to be statistically significant at a given significance level are kept in the order regression. Then, the lagged values of x within the reduced augmented order regression are jointly tested using the f-test to test whether the combined lagged values of x collectively explain the value of y, whereby p is the shortest lag length, q is the longest lag length. The null hypothesis will be rejected should the lagged values of x be statistically significant to remain in the order regression. It should be noted that the Akakai info criterion has been built into the Litebolt RN2 to determine the appropriate lag length, as well as the Leung box test, which will be mentioned later. Now, after the variables have been correctly ordered with the chosen pairs, the Litebolt RN2 will proceed to the modeling procedure. Let's then discuss vector error correction. Following the Johansen test for cointegration and Granger causality, a VECM model is applied to the data. The VECM is a combination of a vector order regression model with its respective error correction component. Such a model is extensively used in Granger representation theory, in scenarios such as this. Simply put, the var portion consists of one time series obtained from the chosen pair that is modeled as a function of the dependent variable's lags and lags of the co-integrated pair, i.e., independent variable. The error correction component corrects for abnormalities from the equilibrium relationship in the immediately previous period. This is so that the model is correctly specified. The significance of such a combination allows forecasts to be made based on historical information. One of the main advantages of using the VECM instead of the simple var model can be understood by the interpretation of the result. This is mainly due to the fact that the main ambition of the model is to obtain a long-term relationship between the chosen variables that also captures the respective co-integrating relationship. The Litebolt RN2 also has the ability to correct any possible deviances from the long-run equilibrium, i.e., correcting for short-term shocks using impulse functions through deep learning, which will be mentioned towards the end of this video. To fully conceptualize the VECM, let us have a look at the var component. More explicitly, a var model is a set of n variables, each of which is calculated as a linear function of p lags of itself and of all the other n-1 variables. Like any other model, there is an error term, as you can see below. If the chosen variables are indeed co-integrated, a VECM of the bivariate regression will look like the following. where yt equals alpha naught plus alpha 1 xt is simply the calculated long-run co-integrating relationship between the two variables, say Bitcoin price as y and Litecoin price as x. Furthermore, lambda y and lambda x are the error correction parameters, measuring how, for example, Bitcoin and Litecoin prices react to deviances from their respective long-run equilibrium. Now, let's have a look at the inclusion of the error correction component, as you can see below. After finding x and y are co-integrated, then alpha naught and alpha 1 is identically distributed with order 0. In the single equation model of co-integration, the Litebolt RN2 can see that the equation above is an appropriate specification of the error correction model. Then, the var plus error correction component equals the resulting VECM. After incorporating the error correction component to the var component, the resulting model is what is known as the VECM. This single equation error correction model now allows both y and x the liberty to develop jointly over time. In the bivariate case, there is only one single co-integrating relationship, and the y equation of the VECM is similar to that of the previous slide, except that the Litebolt RN2 emulates the var specification by inserting lag differences. With only one lag difference, the bivariate VECM can be written as the following. The above equation, number 8, is the model that the Litebolt RN2 uses if only one lag is needed. It is important to note that the Liang-Box Q statistic is used after estimating the residuals using a VECM model with one lag. Now we have established the model, we must determine the appropriate number of lags to correctly specify the VECM. In order to determine the appropriate lag length, both the Liang-Box test and the AIC are calculated and compared by the Litebolt RN2. This is to ensure the final VECM is correctly specified, whereby the Litebolt RN2 then takes the average optimal number of lags in building the model for the chosen pair. The Liang-Box test can be defined as follows. H0 signifies that the data is identically distributed. HA signifies that the data is not identically distributed, as in it displays serial correlation. The test statistic is as follows, whereby n is the sample size, pk is the sample order correlation at lag k, and h is the number of lags that will be tested. This test is consistently used in ARMA and ARIMA models, but is also appropriate in this scenario as the Q statistic will display at what lag the error terms are statistically significant with regards to the respective residuals. This test allows Litebolt RN2 to realize the exact number of lags to purge the problem of autocorrelation and thus choosing the optimum number of lags. Autocorrelation is essentially the degree of similarity between a given time series and a lagged version of itself over successive time intervals. This is why it is important to determine the exact number of lags in order to correctly specify the model to factor in this feature. Now, for each respective pair, the final VECM has been calculated with their respective lags, and therefore a long-term co-integrating equilibrium can be found. Now, we must not forget the short-term dynamics of the pair. As a result, the Litebolt RN2 will then calculate the impulse functions. It is also imperative to, as a trading bot, ascertain the short-term dynamics of the interrelationship. As a result, the Litebolt RN2 adopts impulse response functions, essentially a VMA, vector moving average, representation of the var, whereby the yt and xt are conveyed in terms of current and path values given two types of shocks, E1t and E2t. This can be summarized by the formulas below. Essentially, This VMA representation of the VAR is extremely useful as it allows the Litebolt RN2, having found and predicted a long-term equilibrium, to trace the time path of an array of different shocks to the variables within the VAR system and the interaction between the YT and XT sequences. The Litebolt RN2, with the assistance of deep learning, will then be able to utilize this representation when there is an occurrence of certain shocks to a variable within the VAR system, filtered through all individual price series in question and the duration until equilibrium is once again restored. To summarize, the Litebolt RN2 will examine all potential pairs that are traded on multiple markets. It is programmed to do so above a certain liquidity level and trading volume benchmark. The bot will then test at a multiple level of significance, the level of co-integration, if any. After determining the chosen pairs that display significant levels of co-integration, the bot will then proceed to order the variables, thus determining which variable is the independent one versus the dependent one. After determining the order, the bot will then model each chosen pair as a vector error correction model, essentially the VAR component plus the error correction component. After establishing the VECM models, the Litebolt RN2 proceeds to establishing the number of lags required so that the respective VECM models are correctly specified. Once established, the bot also calculates impulse response functions to calculate and, with the assistance of deep learning, react to the short-term dynamics of the chosen pairs. Now, the Litebolt RN2 is ready to trade. Mentioning it again, using the methodology highlighted above, the Litebolt RN2 will then take a long position in the portfolio when the portfolio is sufficiently lower than the long-run equilibrium, mu minus delta, and short the portfolio when it's sufficiently higher than the long-run equilibrium, mu plus delta. As soon as the portfolio displays a mean reversion to the long-run equilibrium value, the position is closed and the subsequent profit equals to delta dollars. We thank you for your time and hope that you have enjoyed this video. Be a part of the revolution. Be a part of the future. Welcome to Litebolt.